Okay. Thank you. Thank you for muting. All right. Thank you again for coming tonight. Tonight's guest is Larry, and he is a CPA for over 8 years with experience in tax consulting and preparation, accounting, and financial statement auditing. He brings over 5 years of real estate experience as a multifamily investor himself, involved in syndications, joint ventures, asset management, tax strategies, and investor relations and underwriting. Larry is the co founder and senior partner of PC Financial Services. Being real estate investors themselves, Larry and his partner, Terry On, add value to other professionals in real estate by implementing tips and strategies to help minimize their clients' tax liabilities and effective tax rates. Larry also holds key finance and accounting positions for several real estate investment firms, one being Reed's Equity Group. Not only does he oversee the finance and accounting for these organizations, he adds value by implementing the same tax strategies that he recommends to his clients in order to maximize their investors' returns. More importantly, Larry's married to his beautiful wife, Whitney, and the proud father of their two handsome sons, Larry Third and Weasley. All right, so we're gonna welcome Larry here. Hey, Larry, I'm gonna move over your mic to you so that the stage is yours.
Thank you. Appreciate that. I am truly grateful to be here. Thankful for everyone that showed up that wanted to come listen to me. So hopefully I don't bore everybody to death. I try not to be a typical a typical accountant, but yeah. But one correction is called Raz, not Rees. So just want to make sure my boss, my co-partners don't kill me for not correcting you on the name. But
No
other
problem.
than that, it's all good though. But thank you for everybody. Like I said, like you also said, I kind of focus heavily on tax strategy, tax consulting for professionals in real estate. There is a play on words to that, considering the topic of this webinar, because there is a bit of a need to kind of break that, like to bridge that gap between investors and those tax savings. You hear about how much Trump pays and all of that, and what he's doing is not illegal. It's just he has the proper team in place. So I ask for all of my clients to like just let me do what I do, so you can do what you do, which is raise capital, buy properties, manage, and all that. You probably did not join real estate to do taxes and accounting. I'm just crazy enough to do that stuff. So from that point there, um, I'm just going to jump into. I guess let me share my screen first. Just let me know if y'all can't see that.
I can see it. Looks good.
Oh, we all good here.
Okay. Before we go further, so yes, please leave your contact information and your numbers or emails on the chat box. Also, if you have any questions, you can leave in the chat box or hold on to it until the Larry's presentation is over. Then we could have a Q&A session. Okay.
Awesome. So here's what we're here for: real estate professional status, reps, uh, a story of a tax benefit. What type of story? I guess it could be a love story. We'll go for that for right now. This is a nice little love story about taxes. Um, a little introduction about me, outside of what Yosef has already mentioned. I'm born and raised in Norfolk, Virginia. I still stay there to this day. I actually got my interest in accounting through a high school crush on our accounting teacher. I think one of my friends, James Jones, is up here. He probably remembers her. Didn't work out with the teacher, but at least I learned accounting, I guess, for whatever that's worth. But kind of took that and then did your typical rich dad poor dad route. Go to school, got a job, got the certifications, all that good stuff there. And then through my partner Terry on Conyers, I actually learned about investing into real estate. I already knew the benefits of real estate from a tax perspective, but to actually see myself doing it and kind of go beyond that limiting mindset, just having him on my corner helped me with that standpoint there. So just my life has kind of been about surrounding myself with the right people to kind of get me to the places where I like to go. So, and That's my rug rat of a family there. So any jokes in these slides that's pointed at me or other accountants is at the benefit. You thank my wife for that. So what we'll cover today, we're going to have us talk a story about the Jacksons. We're going to see how they learned about passive losses and real estate professional status, qualifying for the status as well. Do the Jacksons qualify? We'll end our story with that, and then we'll address some other scenarios to how to apply to other people on this call or just anyone out in the call, because there's multiple scenarios, but we'll just kind of cover briefly, and then now what there's kind of a plan of action in place. Just disclaimer, this is all kind of in general. Though this is a story, there is truth. This is based off a true story, and I'm protecting their names as well. But a lot of information is just in general, so I always recommend people to talk to your tax professional or a tax professional such as myself that specializes in real estate to see how these tips and this information applies to you. I don't really expect anyone to kind of just go in and just start hitting the ground running with this stuff. If you do, great, like knock yourself out. But please consult with professionals and make sure you're taking the proper steps in place there. So let's meet the Jacksons. Let's get into the story. So we got Tanya and Jerome. I mean, lovely family, 2 kids. The only thing you don't see is their dog. I accidentally cut off the son's face here. But so when they got married, they both had high-paying jobs, making over $150,000 a year. And Tanya wanted to focus on raising the kids, and Jerome stayed in work. Jerome got the bug to invest in real estate, and he bought this triplex and was cash flowing and operating very well off of it, just from tips from his going to bigger pockets, co-workers. So he wanted to kind of raise additional money to replace his income so he can retire as well and spend more time with his family. The problem is, even though he bought the real estate, got depreciation, and all this stuff that he kind of Googled on his own, because it's all public knowledge, like he always still struggled paying taxes, mainly because of his high W-2 job, and he just couldn't just quit at the moment right now. But he heard about, like, how come I'm not seeing the tax benefits that I'm hearing all these real estate moguls are making. So at that point, he finally listened to his wife Tanya and then go talk to a tax professional to help them out with this. And they met some tall, dark CPA, let's call him Lawrence, and he kind of introduced him to passive losses and reps. So the reason why that he's not seeing any benefits on his tax return is because rental real estate activity is considered per se passive. Which means the passive losses and his active income do not mix at all. Those are typically 2 separate buckets, unless you qualify for certain things to allow you to activate those losses, mainly other passive gains or selling of your rental portfolio, which he wasn't trying to do. So those losses so even though he was operating very well, NOI was strong, and he had a tax loss after depreciation and so forth and other tax deductions there. He had these losses that were just kind of sitting on his tax return that were suspended to future years. So they don't really go away, they just kind of sit into purgatory, is the way I like to put it. So, but there are exemptions. One being, if your income is less than $100,000, you can qualify for $25,000 of your losses to be offset your active income or W-2 ordinary income. But he didn't qualify for that. His salary was over $150,000 a year. So another one of the exemptions is real estate professional status. So that is an annual election that allows for real estate professionals to offset their passive losses and to their active income with no limits. So with that case, now how to qualify for that, and as Lawrence continued to explain to them, There's two criteria. One is you have to work at least 750 hours, and half of your working hours have to be in a real property trade or business. If you're married, filing joint, that can be either spouse in that standpoint. And some of the examples as listed here: construction, management, leasing, broking, and there's some other examples. What's qualified as a real property trade or business, but that just qualifies you as a real estate professional. In order to qualify, in order to take those losses and apply it to your active income, you must materially participate in your own rental activity, which means you need to be making management decisions that are affecting the day-to-day operations. And how to prove material participation, there's multiple ways to do it. One of the easiest ones is that you spend 500 hours in qualifying work that whether you're a property manager. So those are the type of hours that you really have to kind of be tracking and taking advantage of. So Lawrence kind of continue on and explain that this is a very aggressive tax strategy. It's a very highly litigated one because the out of all the cases I've read, like I've not seen one where someone has actually had a full time job and passed this, and it's all about the particulars, and mainly in how you're tracking your hours, how you're proving that you're working more than 750 and half of your work time. So do the Jacksons qualify from this standpoint? Does Jerome qualify? And I hate to give this blatant answer. It depends, but it's tough to prove on his behalf because he has a full time job, and basically it's unreasonable to expect that someone that working 40 hours a week, 40 plus hours a week, if you're working, like really no one's working 40 hours a week, and then you're working 41 plus hours in a real property trader business. That's like no one is passing that. So more likely than not, even though this is his property and he's putting all the time to get the work done and all that, like he's not gonna be able to have a credible case to prove that he's a real estate professional from that standpoint. But the kicker is that Tanya does not work, and it's very important to point out. Even though she has not been involved, it's important that she knows that down the road that this is something that she can pick up on her plate. So it kind of goes back to the question: does Tanya qualify? And it still depends, but her situation is more reasonable to believe than Jerome's, because I mean the kids go to school and then she has a huge block a day where she can actually have a business, a real property trader business to kind of build off of. So maybe she starts that property management business and manage the property out of her own home, and she may start up with their own property and then start to build out other properties as well, from that standpoint. But it's also important to remember that both can contribute to material participation. Only one has to be a real estate professional. One has to qualify, but both can put hours into proving material participation in a portfolio. So if Jerome likes to swing hammers, he can do all the construction work. Tanya is managing the property, looking over leases, dealing with tenants, and then both can attend certain trainings. I say certain training because you just can't say educational is not really a strong enough. If for example, I'm a CPA, I have to take certain amount of credits, like CPE credits per year, in order to keep my status. Same thing for most jobs. There's required training to improve your level of work, and that's the same thing for Tanya if she wants to do property management training. Same thing with Jerome, he wants to do construction renovation training as well. So both of them can contribute to material participation, but in this situation, Tanya will be the one that be qualified as a real estate professional, and that would help trigger those losses to offset a lot of his W-2 income. So that's where they kind of sit at today, where like she was not doing in the past, and now how they plan for 2021 and beyond is critical of how they're going to track their hours, and they've been given guides and modules on how to do so as well. But that's just one scenario. there's other scenarios as we phase out of the Jacksons and talk about like other people in the world as well. Um, the main thing is, let's just say one spouse runs a business, other spouse doesn't work. From that standpoint, they're still similar situation as the Jacksons, but now the spouse that has the business can now alter their role, alter their hours in their own business, where they can possibly qualify for real estate professional, and then once again, both can contribute to their rental portfolio. The kicker is most people are now like both spouses are working full time, and it's applied to people that are single as well, where it's still very difficult to prove that case. Now how do you kind of track back time, and like is it really worth it if you're trying to cover the bills off of one salary or one and a half of your salary from that standpoint, so one person can just focus on the business. But like I say, it's difficult if both spouses are working, or if you're single working a full-time job, to show that more than half of your work hours is outside of your W-2. And if so, then like, okay, you may be putting your job at risk, and you maybe are. We're all searching for financial freedom and trying to leave our jobs anyway. So it may be something someone may press down the road, but like I said, I just haven't seen a case where a full time employee has passed it. So now what? So I know I kind of quickly kind of go through this. I know there'll be a lot of questions, and I try to make it very simple, and hopefully the story with the Jacksons help a bit. But from here, is to meet with some professionals, whether it's tax professionals or learning professionals in property management, learning with contractors, brokers of, okay, if you're going to take on these tasks, okay, you may need to work with the right people from a legal standpoint. Do you have the right entity to run certain businesses, insurance and whatnot, and start to build your entity that way, and your business that way as well. Um, Put a plan in place. Once you start meeting people, start structuring a plan, see what works for you, see how down the road, maybe it may not be for 2021, maybe for 2023 and beyond, that you possibly can. And then execute and reassess from that standpoint. And tracking those hours is very, very key when it comes to the evidence. Because if the IRS ever decides to pull your tax return, and you're saying that you're a real estate professional, then like it's very critical that you have the supporting documentation to make you seem credible from that standpoint there. Um, I like to end most of my presentation with this quote from Jim Rohn. I mean, we're all in this for, there's the money aspect of it, but there's really the time, which is way more important, because we don't get too much more of that at all. So I just had like to have this as a reminder um, to myself and for others as well. And I mean, I thank you all. Like I said, I know it was kind of quick and a bit high level, some details, but so I'm happy to answer any questions. Um, that's the link to my virtual business card. Thanks Yosef for the for the app. Like, please reach out if you have any questions. You can book a time. You can see other recordings I've been on, and that's it. That's my son took that book from me, but for some reason he doesn't want to clean his room. But that's neither here or there.
Very cute. Very cute.
But that's it. I'll stop sharing, and I'll answer any questions that may be in the chat.
Okay. Well, I know you guys probably may have typed in the chat box, but I want you to guys be engaged. So let me start from the let me see. Teresa, can you unmute yourself and ask that question?
Sure, sorry. So I have heard that it is possible to reach rep status by being a real estate agent or a realtor. Do you have any advice on this?
Well, it's important to remember that like rep status or reps isn't a job designation, so you don't have to be like it. Can it help? Um, Potentially, because you are working in a real property trade or business from that standpoint, but you also are you materially participating in that business, which means you have at least 5% ownership of that business. Whereas you can be a real estate agent, work for a brokerage, but the brokerage is linked to your agency LLC that you have with yourself. So yourself, you are a walking business yourself, and your 1099 is going to your business and not to Teresa from that standpoint there. Um, but then also that gives you the opportunity to kind of show your own properties, and from that standpoint, and that kind of helps with that second criteria there. So I would definitely recommend, if you're going to be an agent, be sure to have an entity structure set up where you are a business through as an agent through your own LLC, working with a brokerage.
Thank you. I'm sure some of you may have heard this term probably for the first time today, the real estate professional status. Just to try to recap here, as usually when you do real estate investing and multifamily, the income that you get from this rental incomes are usually considered passive income, right, Larry?
Yeah, so to that standpoint, so for example, I have clients who have like 6 figures of passive losses built up on their tax return, and they are unable to offset that income off that loss, because passive activity and active activity, i.e. W2, wholesaling, flipping, like those buckets do not mix unless you qualify for certain qualifications. One being your income threshold. If you're less than 100,000, you got that $25,000 allowance that you're able to write off, and then if you're above that and you start to phase out once you get to 150,000, that's when people start to trigger in, how do I qualify for real estate professional status? Or you can sell your rental portfolio, and the gains from that can be offset by those losses. But unless you really want to sell that property, you probably want to hold on to it and have the cash flow coming in. So that's typically not an option for a lot of folks.
All right. So this is huge, I think, guys. Let's say you have $10,000 per year passive income, and through a cost segregation study, you were able to pull like $100,000 loss upfront, and then you get, let's say, $20,000 loss for your portion. Now you can only offset 10,000. The remaining 10,000 will go to the next year theoretically. But if your real estate professional status, you can apply that $10,000 excess to your active income, which will offset another 10,000 for your tax liability. I think this is huge. So,
And it's also important because I know a lot of people up here are probably syndicated. I mean, or limited partners on syndications. Um, just remember that K1. If you're working with uh, your GPs should be consulting with tax professionals, using cost segregation report or analysis to help accelerate depreciation and claim some bonus depreciation in order to drive down that net operating income to a tax loss, and that will pass on to you as your on your personal tax return on that K1. Remember that being an LP in a syndication does not give you material participation to qualify for the real estate professional status, because you're not actively involved. Like you are passive in that way. You're not making management decisions that affect day-to-day operations. Even though some LPs do feel that way, technically you don't.
all right, thank you. Javier, you could unmute and ask question, Amanda.
Yeah. So I guess just based off of what you just said, Larry, so does being a GP in a deal like that qualify you for rep status, even if you have a W-2?
Depending how your hours, it's still an aspect of your hours. So being a
Still
GP,
hours.
what piece of the GP are you doing? Like, are you the one? Because some GPs have in-house property management. Are you actively involved with that? Um, I say I'm on the accounting end, so even though I am the accounting person for our syndications, my hours don't count, even though it's in that real property trade business. So it's still dependent upon what's your activity in being a GP as well.
And that same 750 hour threshold applies?
Yes.
Okay. What's the best way to track and prove those hours?
Uh,
Like
I
an
mean, I,
Excel file or?
I mean, I have a spreadsheet that I give to my clients that kind of helps provide some guidance of, okay, here's hours that count, here's hours that don't count. Because if you're doing this while working or running a separate business, then you're having to track both hours because you're trying to show that, okay, even though I have this job, I'm only working part time, and I'm really spending 75% of my time uh, in my real estate business.
Got it. Thanks.
Okay. Guys, even though this was mainly on real estate professional status tax questions, but you could have, if you have any other tax questions about real estate investing, today is the day. We have Larry here to answer everything and anything. So please don't hesitate to do that. Noreen, why don't you unmute yourself and ask that question?
Yeah, perfect segue. Thank you. Because this is a little bit digressing away from the real estate professional status. Just, and you might have just touched on this, but I was typing, so I might have missed it. I've heard something about in regards to depreciation of property and how that could potentially offset. Is that something that is true? And if so, is that applicable only for non-multifam or it's also applicable towards multifam units?
Are you referring to depreciation in general or anything in particular regarding depreciation?
I just heard like overall general, so maybe there's something like a caveat that I'm not aware of. This is just me hearing hearsay, so
Right.
I don't know if it's true. I just thought I'd throw it out there so to see if it's even something factual.
Cool. So yeah, so thank you for your question. So depreciation itself, the best way to explain that is whether it's a multifamily, whether it's a single family house or a 100 unit apartment building. If you buy that building, you just can't write that off because it's an income producing asset. So it's a balance sheet item. Geek accounting talk. so, so from that standpoint, there, the best way depreciation comes in is that's the government saying, okay, you're renting this property out, whether it's a single family or a multifamily. You're trying to provide housing to the masses. Good for you. We want to support this and incentivize other people to do so. So we'll allow you to recover the cost of that building over a certain amount of years. Typically 27 and a half years for residential properties, 39 years for commercial properties. Um, that was kind of probably worthless, like not useful at this time, but but so to your point, so that depreciation, so there's now becomes a expense line item, sometimes called a ghost expense, phantom expense. So that becomes a below NOI line item. So your NOI can be 10,000. You may have depreciation of 11,000, leaving you at a loss of 1,000, and that passes through to your personal tax return.
Oh, I see. Okay.
Depending if you're not a C corp, but like, I'm sorry, I digress.
No, no, but this is like it's just good to hear. Like it's good to understand a little bit more. So thank you so much for answering my question.
Well, thank you.
Okay. Jason Kyle.
Yeah. Yeah, I missed writing down. It might have been all on that one slide, but maybe just really if you could dive into what counts towards the 750 hours. Are there any kind of count that you should be aware of? You'd hate to find out at the end of the year you didn't qualify when your whole plan was based on it.
Yeah, so you have construction, so construction, reconstruction, um, management, so property management, leasing. Um, I'll try to always try to rally these on top of my head and do a terrible job at it. So like even that aspect of being an agent, like I say, now you're kind of getting more involved of like, okay, are you selling? You're selling properties as well. So there's like I said, there's about 11 um, of those properties there, but that's kind of a good start there. If, like if you're in construction or you're in you're in new development, um, acquisition of properties, conversion of properties from you may buy a hotel that's pretty popular now and convert it into a multifamily. Like you could be actively involved in your business doing that. Management, brokerage, and so forth from there. Hopefully, hopefully that answers your question.
What about yeah, education, continuing education?
So that's where it gets a bit dicey, because the premise of it, of the real estate professional status, because at one point you had a lot of high net worth individuals taking advantage of these passive losses, and without getting into a whole bunch of like IRS codes and whatnot. So they somewhat closed that loophole or prevented someone from just, oh, I went to this real estate conference and I didn't really do anything, and I make $300,000 a year, but I'm gonna write all those losses off as passive through my business, from that standpoint there. Or someone who just kind of dabbles onto Zillow to research properties and is like, they don't really close on any deals. So are you really a real estate professional, or are you just found a loophole? Like, that's actually a true loophole in the system, like in the system that the IRS closed. But then they had to open it back up to, okay, for those who are actually professionals in real estate, okay, if you qualify for these things, you have proven that you are a professional in real estate. So when I say that certain trains become iffy, is because if you're going to do construction and you build stuff, Jason, you build stuff. So if you do construction, if you're getting training on how to build houses, like, that can potentially factor into your hours then, because you need that training to better operate your business.
Okay, thanks.
Thank you.
I actually have a follow-up question on that, Larry. How about underwriting? So, before we find one deal, I underwrote about 20, 30 of other properties before finding the one that I closed. And somebody told me I'm not going to be able to use that hours, even though I literally spent like probably 20, 30 hours on that, because I have not closed on that particular properties. Is that true? Like, I can't use those hours?
Yeah, that's where it becomes, that's a little more grayer to your point. Like, say, if you're, because we're all underwriting deals. Like, I mean, I know for the month of February, I looked at 60 deals myself, and submitted LOI on one, and like I said, that one didn't go through. So yeah, so like those hours technically, like you didn't really close on. Like, are you really in acquisitions at that point? So the underwriting kind of bleeds into acquisitions if you're actually acquiring the property. If not, then, like, okay, you may be perceived as just kind of dabbling, just doing some high level underwriting, but not really doing, like, anyone can just underwrite, just like anyone can go on Zillow and look up a price for a property.
Gotcha. All right, thanks. Jay, can you unmute and you could ask a question?
Sure. Apologize if I missed anything you already said, but the capital gain is the gain on sale, so I understand that will be tax. But you said something about distribution, not tax, for limited partner because they are not active investor. And what about the 1031 exchange at the end of a holding term? And if they wanted to scale up and invest it again to something bigger pricing?
Yeah, so thanks. I think there's multiple questions that you asked there, and I'm gonna try to dissect that.
Right.
So for the capital gain piece for the LPs, so at the end of the cycle of a property, if the GPs is going to sell it, and depending on that equity split with the LPs, any gains will be allocated to the LPs as well, and they will be taxed on that from that standpoint there. Now, I paused there because depending on what's going on else in that LP's tax return could help offset some of those gains from that standpoint there. The other aspect of it, so so did that cover that first question there a bit?
Yeah.
Okay. So now for the second part of your question, like the 1031 piece. Now, if you're LP investing into a syndication, like, that's a decision of the GPs if they're going to 1031 into a larger property. And typically, I haven't seen too many GPs that's keeping their investors in and then moving money into a bigger deal. But if this is your property that you're selling, then like yes, like you have to first of all find the right custodian for those to intercept those funds, and then the whole 45 180 day clock starts to begin at that point there.
Okay, thank you.
Thank you.
Okay, we have Teresa question.
Oh, she's back.
Okay, I can read that question. Can you claim these suspended past losses during a year you become real estate professional status, trying to strategic and time my losses so they coincide with the year I become rep status?
Yes, and that's where we can have some fun because because it's a annual election, you have to elect to be real estate professional every year. It's just not a you did it for 2021 and you're kind of stuck with that for your rest of your life. Like you have to kind of go in and do it. So depending on the activity during the year, it may or may not be worth it to do so because you're putting those particular properties and yourself under scrutiny if you're ever going to be called. But if you actually have a lot of gains coming in, as I mentioned before, I have one client who has like $124,000 of passive loss suspended, and he can't qualify for real estate professional status in 2020, but he has some syndications that he's in, and that's going to come in 2021, and he had his own personal portfolio. So okay, so now 2021, we're going to shoot for getting him in place to qualify, and just kind of like here's a spreadsheet. Start tracking your hours this way. Is a tedious aspect to it, but to see those type of deductions on your tax return becomes worthwhile.
Okay, thank you. That's a good question. How about part-time W-2? Let's say they work 20 hours, but not 1099, they could still get W-2, and it becomes easier for them to prove as
Yeah,
opposed to
it's a
full-time,
lot easier
right?
because I mean, yeah, because what is it? I mean, we all work a lot of hours. So if you're full time and you're saying 40 hours a week in your W-2, and so you have to save 41 plus hours a week if in your real property trade business. At least with your part time, okay, you may be working 15, 20 hours a week. That's okay. You have a little more flexibility. Okay, I actually work half the normal work day or work week in my W-2, but then I work a little bit more than that half in my real property trader business. Because at the end of the day, you're not really trying to prove anything to me. Like I believe you. I'm on your side. But once the IRS comes and we're in the tax court and we got swear on the Bible and all that stuff, okay, like or is the judge going to believe you at that point? Then, so it's all about this kind of remaining credible from beginning to end.
Gotcha. Thanks. Anyone else have a question? Oh, Aaron.
Yeah, thank you. And first of all, Larry, thank you for tonight. This is awesome, learning all this stuff. I've got two questions, one of which is I sell a property. Passive losses and carried forward passive losses can be used to offset capital gains in the event of a sale. Can it also be used to offset depreciation recapture in that sale?
Yes.
That's a good answer. And
yes.
Number two, that 500 hours, does it have to be directed towards an individual property? I was thinking there was some sort of limitation there. Can it?
Yeah. So it's called a section 9 election, whereas okay, you may have 10 properties because you got it like that, Aaron. Now, are we expecting you to spend 500 hours on each property to prove real estate professional status? Like no, that's impossible, and you probably be Superman, but you probably still can't do that. So that non-election is allowing you to say, okay, to group all those properties together, and as a total, you spent 500 hours in your portfolio itself. So you may have done 100 with one, 50 with another, so forth and so forth, until you actually reach that 500, and you probably did construction on one. It also works with the type of work that you're doing. It doesn't have to be just construction. Like if you did construction and you're doing the leasing as well, and you're managing the property as well, then like those hours all kind of can be grouped together. So you can group certain properties together because it doesn't have to be all of them. You may have 10, but you qualify for just 3. So just those 3 can give you the loss that you're looking for.
Okay. Thank you.
Thank you.
Great, thank you. Anyone else? Do I see any hands raised?
I have a question.
Yes. Who is this?
It's Ted.
Hey, Ted.
Ted? It sounds like you're talking about personal income. Shouldn't anybody that's buying some sort of rental property or rental properties put everything under an LLC?
Yes, I mean this will still be under LLC. So the actual election or the entity structure that you're doing, because so you have a property, it may be on the LLC. It'll still be reported directly on your tax return as a Schedule E, unless you're in a partnership or you're electing to be taxed as an S corp. Then it'll be a separate tax return. That still passes through to your personal tax return. So even if your property is in an LLC, those losses, whether it's an LLC or LLC tax as an S corp, tax as a S corp, those passes through your entity to your personal, and then they sit in your personal tax return looking for passive gains to eat up against.
Okay. All right. And
There's a legal aspect of it that you're trying to factor in, and there's the tax aspect of it. Yes, your property should be in the LLC for asset protection purposes, but how they're treated tax wise is not always is going to be consistently the same.
do you ever see somebody should have it under their personal income and not under an LLC? Like if you just own the one property and you're going to take all the income personally, or is it always go through an LLC? Well, I know for liability reasons, you're crazy not to do an LLC. Somebody slips and falls on your property, something like that, you're going to have a problem. But
well, the main thing is to remember that from a tax perspective, your LLC is a disregarded entity from that standpoint, which means that your LLC would not be taxed. Like whatever activity, income, like that is going to pass through your LLC to you personally, unless, like I said, unless you got in a C corporation, which that's a whole nother level because you deal with the double taxation there, and it's all kept into there from that standpoint. But the regulations from that standpoint still apply even for C corporations if you're trying to keep it out of your personal. But if you just have it in an LLC, even if you're in a partnership like a multi-member LLC, everyone's going to be issued a K1. If you have losses, kind of back to the point earlier of whether it's an LP, even GP is going to get a K1 as well. If there's a loss, that loss is going to sit on your personal tax return, and depending on where your income is and if you qualify, it depends on whether or not you can net those losses against your personal income.
so one other question, if you do a syndication in the United States, do you have to qualify as an investor under that syndication? Do you have to do investor qualifications? Like in Canada, in order to set up a syndication, each one of your investors has to be vetted as a qualified investor.
Now, that's more of a legal question, so I'll speak. I'll just want to throw a disclaimer out there that I'm not a legal representative. So it depends on the type of entity that you're setting up or type of capital raise that you're doing. So there's 506B, there's 506C, there's crowdfunding, so your Reg A standpoint there. So I believe if you're doing the 506C, that it can only be accredited investors. And don't quote me on that. I get C and B mixed up like all the time, but in order to, and Yosef probably knows, but if you're doing the 506B, which like you can do accredited and non-accredited, but certificated investors, then you still have to qualify your accredited investors, but you still have to have some type of pre-existing relationship as well. But then if you get into the crowdfunding and Reg A stuff, then it's a bit more open and a lot less. It's still highly relegated, but it's a lot less like qualifying of the investor standpoint.
You
So
got it right. Yeah.
Is that regulated federally? Or is it by the states down in the States?
Federally.
It's a federal regulation. SEC.
SEC will be kicking down doors.
Yeah.
They don't kick any doors down. They should be kicking some doors down.
We'll see.
All right.
Thank
you, Larry.
To all the people that are there tonight, how are the with COVID? How is rental vacancies being affected in the United States? Is anybody seeing any downturns or expect any downturns or?
I mean, I'll speak for myself, where like you're just trying to adjust to all the eviction laws that just keep changing, and they just keep kicking that can down the road. Where I say typically you want everybody on an annual lease, but if you're dealing with unable to non-paying residents and you can't evict them, then okay, once their lease expires, so you're now converting people to shorter term leases, so you can actually remove them quicker from that standpoint. So it's an unfortunate circumstance, but you have someone just taking up a unit, and they're not paying, and it's unfortunate for them. And you try to work with them, and the relief is coming in as slow as it wants to, and you try to be as flexible as you can, but know that you're running a business also.
Yeah, we have in the province of Nova Scotia, we have a 2% rent freeze till 2022, and we can evict for any reason other than BRRs. So if we want to do renovations, we can't evict for renovations, but we can evict for non-payment, for destroying your property, all the regular stuff. But still, we're on a 2% rent freeze for the next 2 years or year and a half, and that's 2% on 1,000 isn't going to get you anywhere, right?
Yeah. I think mainly New York. I mean, there's some. I don't invest in areas where there's like a rent cap or anything like that, or rent restrictions. I'm not sure if anybody else up here does. And how
yeah, we never ever had one. It's just because of COVID, they brought one in for a couple of years. Yeah.
Right. Thank you. Well, I personally believe multifamily, the property type, is a good investment, especially during this type of pandemic situation too. Well, personally, our property has been historically over 90% of collection rate, but also compared to the retail stores, I think people, because you're living there, they tend to be more responsible for their own place to live. All right. Any other questions about tax? Okay. I appreciate, Larry, for your presentation and your answering all the questions that you have. And thank you for coming, everyone.
Thank you. Oh, I think I may have.
It was a great time. We'll ask, how can people reach you, Larry, again?
Yeah, I'm gonna throw my number. I thought I put my number into the
presentation.
But I thought I put it into the group chat.
Oh, you did? Okay. If you did, I'll be sending this out to you guys through emails, and the recording will be sent to you guys as well.
Yes, I mean my number's up there. Like text, like call, leave a voicemail, because I don't answer numbers I don't recognize, but I do reply back within 48, 72 hours. It is tax season, so bear with me. But thanks Yosef for the opportunity.
Thank you.
Thank you for your questions.
Have water in your room, Julianne.
Stop. Can I get some water too?
Mommy's ticklish. You're supposed to cuddle me.
Oh, that's so cute.
I muted it.
I want some water.
I heard this cuddle bug, and I was like, I can relate. Parenting.
Okay. All right.
Thank you so much, everybody. Thanks, Yosef and Larry.
Thank you.
Really seeing everybody.
reach out. The chat box will have all yours, what market you guys are in, what you do, and contact information. Take a look at it. Reach out if you're looking different markets, and reach out to me as well. Yosef, Lee, you have my emails and Facebook or LinkedIn. Love to connect and talk about multifamily on Zoom. I know already a couple of you guys I need to schedule, so let's have fun talking to multifamily. All right. Good night. Thanks for coming again.
Thanks, Joseph.
Everybody.
Thank you.
Thanks,
Thank you.
Joseph. Thank you, Larry. That was
Good night,
great.
everyone.
Good night, everybody.
Good night.
All right, Larry. Hold on. Let me end.
I said, I knew my hair was up here. Yeah.